Today, I'm here to talk about the downfall of what was once considered a rising star in the US banking sector, Signature Bank. Signature Bank was founded by these three gentlemen. From day one, the bank was designed to serve privately owned businesses, high net worth individuals, and eventually the growing world of crypto firms. Its success came from a unique blend of relationship driven banking and bold technological innovation. So while the bank's core business was all about relationship-based commercial banking, it primarily catered to privately owned businesses. So its services cover a wide range from commercial real estate lending, which at one point made up 41% of its total loan portfolio, to fund banking for private equity firms and venture banking for tech startups. So on top of that, they also offered private client banking, treasury management, and perhaps what they became most known for, crypto-related services via their blockchain platform, Signet. So for a fun fact, Citibank Bank was one of the first FDIC insured banks to adopt blockchain technology, and in 2019, they launched Signet, a real time payment system that allowed their crypto clients to move their funds 24/7. So, this innovative move made Signature Bank a go to bank for many crypto firms, giving it a strong edge in the digital finance space. But while this bold push into crypto brought short term success, it also introduced long term risks, and that's where things start to unravel. First, it ran on a decentralized model. By late 2022, Signature Bank had 136 private client teams spread across 40 branches, mostly in New York. Each team acted as a single point of contact for their clients, handling both relationship management and lending decisions. So this allowed for highly personalized service and rapid responsiveness to business needs. Second, Signature Bank had a very flat hierarchy. Over 150 senior banks reported directly to the CEO, Joseph De Paulo. So this structure supported what was known for eat what you kill model, which strongly incentivized the bankers to aggressively grow their portfolios and bring new clients. Culturally, the bank embraced speed and innovation. It was clients first, entrepreneurial, and quick to adopt new tech, like their blockchain-based Signet platform. So bankers were empowered to act fast, especially in the high growth sectors like commercial real estate, private equity, and crypto. But this agility came with trade-offs. As signature banks scaled rapidly, it struggled with governance and risk management. So processes were informal, documentation was weak, and key risk controls, especially around liquidity, were underdeveloped. So for a fun fact, the most ironic part is that Benny Frank, the former US congressman and co-author of Dodd-Frank Act, actually sat on Signature's bank's board. So after the collapse, he controversially claimed that the regulator seized the bank not because of insolvency, but to send a message against crypto. Started in mid to late 2020 during the post-COVID economic recovery as the US economy reopened, businesses resumed operations, and demand for financial services surged. Signature Bank benefited directly from this rebound. Then came a period of what many call cheap money. From March 2020 to the end of 2021, the Federal Reserve kept interest rates at near zero and introduced expansionary policies. So this boosted borrowing capacity and liquidity, resulting in record deposit growth at over $40 billion in 2021. November 2021, it attracted numerous crypto firms through its Signet platform, leading to a massive inflows, but also setting up future risk concentration. At the same time, from late 2022 to the end of 2021, Signature Bank leveraged low borrowing costs and high investor appetite to scale up its commercial real estate lending. On September 21st, 2022, the Federal Reserve raised interest rate by 75 basis points, its third consecutive high of that size. So this aggressive tightening strategy marked a shift away from easy money and signaled growing stress for markets heavily reliant on cheap liquidity. Collapse of FTX, one of the world's largest crypto exchanges, sent shockwaves through the financial system. It wasn't just a crypto failure, it was a confidence crisis. November 2022 onwards, investor and depositor confidence in crypto exposed banks like Signature began to plunge. March 10th, Silicon Valley Bank collapsed. Following a massive bank run to the 12th, panic took hold. Signature experienced a massive run on its uninsured deposits, many of which were tied to crypto and tech clients. And within just a few days, billions were withdrawn, damage was done. Signature Bank was officially seized by the New York Department of Financial Services. And for a fun fact, this wasn't just another bank failure. Signature Bank collapse became the third largest bank failure in US history. So what really pushed Signature Bank over the edge? So number one will be liquidity mismanagement. So Signature held a staggering 82% of its $98 billion in deposits as uninsured. So this left the bank dangerously vulnerable to sudden withdrawals, especially in a crisis. Worse, it lacked strong liquidity buffers and didn't conduct robust stress testing, which meant it was simply not prepared for a run. Number two will be high exposure to crypto clients. So Signature landed heavily into crypto through its Signet platform. So while this initially fueled growth, it backfired after the collapse of FTX and Silvergate. In just a short span, the bank reported loss over $10 billion in deposits as crypto clients rushed to pull out funds. There will be interest rate risk as the Federal Reserve rate hiked interest rate aggressively. So the value of long-term securities on Signature Bank dropped sharply. So this created a serious mismatch between its assets and liabilities, further straining its liquidity and funding costs. They did act, but the response was largely seen as too reactive, too late to make a difference. So number one will be public reassurance and liquidity measures. So the management tried to calm nerves by publicly stating that the bank did not directly hold or trade cryptocurrencies. At the same time, they scrambled to secure funding, emergency funding, tapping into the Federal Home Loan Bank and other sources to manage the growing wave of withdrawals. Second will be executive accountability and deflection. So after the collapse, in post-mortem testimony, senior leaders, including co-founder Scott Shea, deflected the blame, pointing fingers at external factors like market panic and contagion from SVB. But what stood out to many was what they didn't say. There was little acknowledgement of internal weakness, such as risk management gaps or strategic missteps. So this lack of accountability drew sharp criticism from regulators and lawmakers. Third will be last-minute emergency measures. In a final desperate move, Signature extended Fedwire operating hours by 4.5 hours, hoping to process withdrawals and buy time. But by then, confidence had evaporated, and all these efforts were simply not enough to restore stability. In conclusion, the collapse of Signature Bank is more than just a case of one institution falling. It's a clear warning sign about the fragility of the financial system. Without robust governance, diversification, and proactive risk management, even the most innovative and fast-growing institutions can fall apart under pressure. Ultimately, Signature Bank's downfall underscores the need for financial institutions to balance ambition with accountability. Because in today's volatile landscape, trust can disappear faster than any balance sheet can recover.